Think about the daily grind. You wake up early, spend an hour commuting, work an 8-hour shift, and commute back. You spend 10 hours a day physically working for money. But what is your money doing? It's sitting in a checking account. While you are working yourself to the bone, your cash is fast asleep. Let's take a common financial milestone, $10,000. If you had that exact amount sitting in your bank right now, how do you take it from a stagnant pile of cash and turn it into a self-sustaining wealth machine? First, we have to look at the numbers. This chart shows the percentage increases across everyday consumer goods, from food to energy. Keeping your money parked in a bank account often results in a loss of value. With inflation averaging around 3%, while a typical savings account yields barely anything, the purchasing power of your $10,000 drops every single year. You don't need hundreds of thousands of dollars to get started. $10,000 is a practical starting line to build the habit. Passive investing requires no time spent staring at stock charts or researching individual companies. Doing nothing feels secure, but the numbers show it results in a guaranteed loss. The greatest threat to your wealth is the quiet drain of inflation while you sit on the sidelines. To prevent that constant drain, we divide your $10,000 into a 3-layer system: the safety net, the growth engine, and the opportunity bullets. Layer 1 is the safety net. We take 20%, $2,000, and keep it in a high-yield savings account. This cash serves as your psychological buffer. If your car suddenly breaks down or you lose your job, you have the liquidity to handle the crisis without being forced to sell your investments at a loss. Layer 2 is the growth engine. We dedicate 60%, $6,000, to long-term wealth creation. This forms the foundation of the portfolio. Inside this engine, we split the money again. 70% goes into broad, global stock market ETFs for growth. The remaining 30% goes into bond ETFs. Bonds act as a shock absorber. When the stock market gets volatile, bonds typically stay stable or increase in value, keeping the engine running without stomach-turning swings. You don't drop all $6,000 into the market on day one. Instead, you deploy it in $1,000 increments every month for 6 months. This strategy, called dollar cost averaging, averages out your purchase cost and protects you if you happen to buy right before a market peak. Layer 3 is the opportunity bullets. This graph shows the stock market's performance during the drop in April 2022, characterized by a steep downward trend and deep red numbers. You hold your final $2,000 as flexible cash for moments like this. When the broader market drops more than 15% from its peak, you deploy this cash in batches. This specific architecture prevents panic during personal emergencies, while allowing you to weaponize market crashes to your advantage while others are selling. An asset allocation strategy only works if you execute it. Human nature makes it easy to find excuses to skip a monthly contribution when you are tired or fearful. You fix this by opening a zero-commission brokerage account and setting up automatic transfers. You configure the system so that the moment your paycheck clears, the money is routed and invested before you can spend it. Once every 6 months, you do a maintenance check called rebalancing. If your stocks grew and now take up 80% of your portfolio instead of 70%, you sell off that extra 10% and use the profits to buy more bonds. This mechanically forces you to sell high and buy low. By automating these steps, wealth building runs in the background. The system grows your money while you spend your time actually living your life. Let's look at the actual math. If you set up that initial $10,000 and then automatically add $200 a month at a 7% real return, your portfolio will clear $300,000 over 30 years. Albert Einstein reportedly called compound interest the 8th wonder of the world. It is a slow start that eventually snowballs into significant momentum. You need to prepare for the reality of the journey. This graph shows the trading floor data from March 2020. You can see the plunge and the red numbers from the pandemic crash. Along your 30-year journey, you will face drops like this and see paper losses. When those drops happen, your biggest enemy is your own emotion. Fear will tempt you to panic, hit the sell button, and break the entire system you built. This is why your investment portfolio is a secondary asset. Your greatest wealth generator is your human capital. If you spend your energy learning new skills and growing your career, your salary will increase. That higher income feeds more money into your machine, accelerating the compounding process. Effective financial management provides the power of choice. Waiting until you feel ready to start is the only guaranteed way to fail, because inflation is not waiting for you. Take action, set up the system, and let your